Just a quick recording to try and explain the dividend cover ratio and how you could use it in an investor ratio essay. So dividend cover measures the amount of profit the business makes after tax in relation to the amount of dividends they pay. So basically how easily they can cover those dividends with their current profit levels. If you have a high or increasing dividend cover, that gives reassurance to your shareholders that you can continue to pay those dividends or that the business will continue to pay those dividends. So you've got that security, and that is something you can add to your analysis. Equally, if it's high, that means we are keeping lots of profit back. So maybe it's a sign the business is keeping profit back for investment. And if you're doing that as a shareholder, you could look at the longer term perspective and the fact that if they're keeping back profits for investment, that might mean the profits will continue to increase and dividends will continue to increase. So the shareholder may see their return increase in future. However, conversely, if it's a low level of dividend cover, you have to question sustainability. Will the business be able to continue to pay that level of dividends in the future? So you may be looking as a shareholder with some concern because they will be struggling to pay you in future. Additionally, if it's low, you could be saying it's a good level of dividends. So actually, the company is paying a high proportion of dividends in comparison to their profit. So as a shareholder who's looking at a return on investment and just dividends, they'll be quite happy with this company and would like to keep their shareholdings there. However, if it was a high dividend cover, you have to question, is the business not paying enough to shareholders? Could they pay more? And that could have a negative impact on the share price if shareholders feel that they get a better return on investment from another company. It should also be part of your analysis, if it would be a brilliant part of analysis, if in the question 1 year or in the current year the dividend cover was below 1, because that means the company is using previous years' retained earnings to pay their dividend levels. Now that is of major concern. One, it's not sustainable because it would depend on how much retained earnings a company has generated over time, but clearly if they're using up previous years, that would be a problem. And additionally, it is a sign of a business who's struggling. One thing to note when we're discussing dividend cover, its limitation is that we're not reviewing the liquidity of the organization. Just because they're making a profit does not necessarily mean they have the funds to pay dividends, and that's something you could question in your analysis.